This is a video on the equity method of accounting for investments. Some people consider the equity method a quasi-consolidation method. It is a way of doing kind of a consolidation without actually doing a consolidation. Uh, it's kind of like a consolidation. The equity method kind of views the investor and the investee as a special type of single entity, as if the two companies were really combined into one company. Uh, However, when we use the equity method, the investor doesn't include separate financial statement items of the investee on an item by item basis in the consolidation. Instead, the investor reports equity interest in the investee as in a single investment account. Uh, and again, that's the reason I call it basically a quasi, in effect, consolidation, because it essentially collapses a formal consolidation approach into single lines on the balance sheet and the income statement, while it has the same effect on total income and shareholders' equity. Uh, and we're going to see that under the equity method, the investor recognizes investment income equal to its percentage share based upon its percentage of stock ownership of the net income earned by the investee, rather than the portion of that net income received as cash dividends. The rationale for this approach is that the equity method is that the objectives and outcomes of the investor investee are so intertwined that as the investee prospers, the investor prospers proportionately to their ownership interests. In effect, as what really happens is, as the investee earns additional net assets through its operations, the investor has a share of those net assets that also increase. So let's go on and take a look at the equity method. Now, what we're really interested in here is where we're talking about percentage of ownership between 20 and 50%. The presumed influence under this under 20 to 50% is that the presumed influence is that the investor company has a significant influence over the investee company, and typically we use the equity method in accounting. Now, the one thing we have to remember is that the percent of ownership only reflects, again, as I've talked about using this chart in other videos, only reflects a presumed influence and not necessarily the actual reality. It's the actual influence that counts. But let's go ahead and talk about how we use the equity method in accounting for an investment. Now, if we were to take a look at just the very, very general entries of the equity method, okay, what happens is we have an acquisition date, and we will then, based upon the acquisition is recorded at the value of the consideration transferred, and that can also include fees to facilitate the acquisition. And the journal entry is essentially debit investment in sub, and the credit is to cash or whatever other consideration is being given up. Now, during the reporting period, the parent company is going to record their percentage of earnings available to the common stockholders from the subsidiary earnings reported as an increase in the investment and income. And the percent of earnings is based upon the percent of voting stock owned. So in this case, when the subsidiary reports earnings, what we're going to do is we're going to increase our investment in the subsidiary, and then we're going to have an offsetting credit to revenue from the subsidiary for our portion of the earnings of the subsidiary. Now, we also need to remember, although this typically isn't included in the exam, but if we did have intercompany transactions between the parent and in effect the subsidiary, any intercompany transactions and their effects has to be eliminated. When the subsidiary finally declares dividends, when those dividends are paid, what will happen is that the investment in the sub is reduced by the amount of the dividends declared, and that those dividends have been transferred from the subsidiary. So we would debit cash and we would credit our investment in the subsidiary. And of course, if there's any other type of equities, this also includes the value of any other preferred dividends paid to the parent company. So that's a general accounting: the acquisition, the percentage of earnings earned, and then when dividends are paid, we reduce the investment. Now let's take a look at when we make an acquisition of a company under the equity method. And it's best shown through an illustration. Now, in this case, we have an example where the parent acquires a 25% interest in the subsidiary. So a lot of times I'll use parent and then I'll just use P, or subsidiary or sub, and I'll just use S. So the parent acquires a 25% interest in the subsidiary for $300,000. That's a consideration. However, at the time of the acquisition, the sub's assets the fair values are actually $600,000, and the asset carrying value of the subsidiary is $350,000. So in this case, we have to create our investment entry like we did in the previous slide, but there's also some components that we need to track on this that are part of this investment in sub account. Now, the first thing we need to do is realize that we made a $300,000 investment. However, that investment was for 25% of the assets of the company. I'm sorry, 25% of the fair value of the net assets of the company. So if we want to calculate our interest in the fair value of those assets, it would be $600,000, which is the fair value of the assets, times our 25% interest, and that's going to come out to, in this case, $150,000. So we spent $300,000 to obtain a $150,000 interest in the fair value of the assets of the company. The difference between the investment and the fair value of the assets of the company is $150,000, which would be the $300,000 minus the $150,000 interest, which would be goodwill then of $150,000. So we know out of this $300,000 investment in the subsidiary, $150,000 is goodwill. And goodwill itself will never be amortized. It always stays on the books unless there's some form of impairment. We'll talk about that in a few minutes. Now we have to recognize something else. Remember that the company, the parent, purchased 25% interest, so of the subsidiary. So now what we need to do is we need to calculate the interest in the carrying value of the assets of the subsidiary. So that'll be $350,000 carrying value times our 25% interest. And that's going to come out to an interest of $87,500, which means we actually paid $62,500 more than the carrying value of the assets. So under these conditions then, the parent will amortize, in effect as an expense, the difference between the fair value versus the carrying value of the assets. Again, the $150,000 investment minus the $87,500 in terms of the interest in the 25% interest in the carrying value of the assets. And these purchased over the useful life of the assets identified with the fair value in excess over book value. Now, for example, let's assume the subsidiary's assets, in this case, the sub's assets are going to have a remaining useful life, the ones we purchased, of an average of 10 years. So we would take the $62,500 we need to amortize, take that amount, divide that over the 10 years of remaining useful life of those assets with the carrying value, and we would have an expenses. We would have to amortize an expense, or we'd have to amortize that investment to the tune of $6,250 a year for 10 years. So every year we would debit, in effect, revenue earned from subsidiary, which would be an offset from our revenue that we earned in the subsidiary, and we would credit our investment in subsidiary to reduce it for the $6,250. Now again, I know this is a fairly complex entry, but if you take a few minutes and study it and understand that you have to separate your investment from your goodwill, and then the excess amount of assets that you have, the additional amount of value of assets that you have purchased over and above the investment, and amortize that, it's really not that difficult. Now, a couple of other slides just with some information that I don't think you're going to have to ever do any computation on, but it's just something that is nice to know. With the equity method, again, a lot of times what we're going to end up doing is we're going to increase our level of ownership in the company. And sometimes we are going to basically use another method other than the equity method until we reach that stage where we need to use the equity method. If significant influence was achieved in stages, the investors must retroactively adjust the carrying value of the investment, and the current and prior earnings presented and retained earnings must be adjusted, just as if the equity method was adopted at the first instance of the investment. So this involves a restatement. Again, I wouldn't worry about that information too much, other than know that if you did acquire your investment in stages and then you reach the equity method, you'd have to restate everything from its inception. Also, if you have a succession of the equity method, the investment account is going to be eliminated, and the shares retained are accounted for as trading or available for sale securities. In other words, you'd fall down that box where I said we had consolidation, the equity method, and then you had your securities down at the bottom of below 20%. We would then account for those shares as accounted as trading or available for sale securities. Okay, let's try now. We got about nine different multiple choice questions on the equity method, so it doesn't hurt to practice this. So let's go ahead and give them a shot. Okay, on January the 1st of year 5, P, which is the parent, okay, P purchased 10% of S's outstanding common stock for $400,000. P holds 4 out of 10 seats on S's board of directors. In year 5, S reported net income of $500,000 and paid out $150,000 of dividends to common shareholders. So at what value should P report their investment in S at the end of year 5? So again, review the answers, stop the video, and when you're ready, go ahead, restart the video, and view the answer slide. What value should P report their investment in S at the end of year 5? And the answer is B, $435,000. Now, I've reproduced the basically the guidelines for the accounting method for accounting for ownership interests in subsidiaries. And you'll see here it says P purchased 10% of S's common stock for $400,000. Well, if we look at the percentage of stock ownership, basically 10%, it's really not enough to invoke the equity method. We would most likely use the trading securities available for sale or fair value option for accounting for this common stock. However, on the other hand, what we are also told is that P holds 4 out of 10 seats on S's board of directors. So typically, that would, if you're doing four plus seats on the S's board of directors, you probably have a significant amount of influence within S corporations financial and operational decision making. So under this case, the presumed amount of influence, or the amount of influence, was presumed to be little or none. However, because we know the facts that the board of directors, 40% of the board of directors is made out of P board of directors, we actually probably have at least significant influence, not necessarily controlling, but significant influence, which would state that we'd probably be using the equity method. So in this case, in order to account using the equity method, our acquisition would be $400,000, and then we count our income, which was basically 10% of $500,000, which is $50,000. Then we subtract out the dividends paid, so the ending investment balance would be the $435,000. Okay, let's try number 2. At the end of the year, P purchased 30% of the common stock of S for $200,000. On that date, S's stockholders' equity was $500,000 and the fair value of identifiable net assets was $600,000. What amount of goodwill should P attribute to this transaction? So again, look at the answers, stop your video, and when you're ready to view the answer, go ahead and restart your video. Okay, in this case, the question was, what amount of goodwill should P attribute to this transaction? And the answer in this case would be B, $20,000. So we start out with P's investment of $200,000. Now we need to subtract out, or to determine if there's goodwill, we need to determine what percentage of the fair value of identifiable net assets did P actually in effect purchase, which was 30%. So it would be $600,000. The fair value of the S's net assets would be $600,000 times P's ownership interest of 30%. That would be $180,000. So in effect, P paid $20,000 more than the fair value of S's net assets. In other words, P paid $20,000 more than the assets were worth. So that difference again is $20,000, and that would be the answer for goodwill. Okay, let's go on now to question number 3. P used the equity method to account for the purchase of S on January 1st of year 10. On the date of the purchase, the fair value of S's inventory and land exceeded their carrying amounts. How do these excess amounts of fair value affect P's reported earnings for S? And you're given your 4 choices in the multiple choice. Stop your video. When you're ready to when you're ready for your answer, restart the video. Okay, let's take a look at the answer for number 3. How do these excess of fair values affect P's reported earnings for S? And the answer is B. The inventory excess, it would decrease the reporting earnings for P, and in the case of the land excess, there would be no impact. Now, as we analyze this, I think you'll understand what's going on here, and you'll be able to apply it to other similar situations. Now remember, if we actually spent more money than the fair value of the assets that we are purchasing, we're going to depreciate that excess over the life of the assets. Now, if we take a look at inventory, basically it's not like a building, or it's not like a piece of equipment, so we would amortize that since it's a cost of the inventory, we would amortize that over some form of inventory turnover, because that would be the most rational way of allocating that expense. In the case of land, land itself will not depreciate, so there's not going to be any impact in this case. So let's try number 4. P acquired 40% of S Corporation's or S's common stock on January the 1st of year 2. The carrying amount of S's net assets was $900,000. Fair values equaled the carrying values of the assets except for equipment, where fair value exceeded the carrying amounts by $100,000. The equipment has a 5-year life. S reported net income $150,000 for the year. What amount of income from this investment should P report? Again, you've got your choices. Stop the video when you're ready to to view the answers. Restart the video. So in the case of number 4, the answer is, what amount of income from this investment should P report? And the answer is B, $52,000. So let's go back and take a look at the computation. P's portion of the net income from S would be the $150,000 times 40% of the basically of the equity that P owns, so that would be $60,000. Now we're also going to have to subtract out the excess of the fair value over the carrying value. You're going to have to amortize that over the useful life of the assets that have been identified that basically exceeded carrying values. In this case, it was equipment, and its carrying value was $100,000 in excess, or sorry, its fair value was $100,000 in excess of the carrying value. So in this case, we're going to take the $100,000 excess of fair value of equipment over the book, and we're going to multiply that times 40%, then divided by 5 years. The 40% represents our portion of interest in that depreciation. 5-year useful life, so the amount would be $8,000. So net 5. P paid $300,000 for 40% of the common stock of S. At the time, S had the following carrying values, and we had current assets, plant and equipment at net, liabilities $200,000, and stockholders' equity $220,000. The fair value of the plant and equipment was $60,000 more than its recorded carrying amount. Fair value and the carrying value are the same for all other assets and liabilities. One amount of goodwill should P report under this circumstance. So again, check out your choices, stop the video, and when you're ready to review the solution, go ahead and restart the video. Okay, in this case, the question for number 5 is, what amount of goodwill should P report? And the answer would be D, $188,000. So let's take a look at how we came up on that number. Okay, the first thing we have to realize is we paid $300,000 for the 40% of the common stock of S. So we know that's our purchase price. Also, now we need to measure the fair value of our net identifiable assets, that portion that we purchased. So in this case, it's going to be our current assets plus our net equipment, which would be $420,000, minus our liabilities, which would be $220,000, but then we have to add the fair value of our plant and equipment, which would be $60,000 more. So the total is actually $280,000 fair value of our net assets, of the net assets that we've acquired 40% of. So it's going to be $280,000 times our 40% interest, means that the purchase price of our investment at fair. Basically, we're purchasing $112,000 of the fair value of the net assets of S Corporation. So we paid $300,000 to purchase assets with a fair value of $112,000. The difference between the two then will be goodwill, $188,000, and that would be the answer in this case, $188,000. Okay, and that will be the last multiple choice question for equity method accounting. So again, thank you for your time.